Welcome back to All Things Money. I'm David Blain, and today we're talking a little bit about the payroll taxes during this segment. If you have any questions on the show or anything that you've heard or anything going on out there in the world of finance, feel free to give us a call at 633-0107. Visit us on the web at www.dlblain.com. That's DLBLAIN.com. where you'll find some information on myself and my registered investment advisory firm, D.L. Blain & Company, as well as archived copies of the show, All Things Money. If you missed an episode and want to catch up, they're all right there on the website. So go on over to www.dlblain.com and you'll find all the shows archived there. As I mentioned, we're talking about the FICA tax, how it was enacted in 1937 at the rate of 2%, and today it's 15.3%. The current rate was enacted in 1990. So you would think that after all these years, where did all the money go? When this money is taken out of a worker's paycheck, it's supposed to go into what's called the Social Security Trust Fund. And the trust fund was accumulating money to meet the future needs of an aging population. And after raising the tax in the late 80s, the Treasury decided it made no sense to have all these funds accumulating in Treasury securities, where on the other hand, the federal government was running huge budget deficits. So they merged these two accounts. So other than on a piece of paper, there really is no more Social Security Trust Fund. And the surpluses in the Social Security Trust Fund, which it was running surplus, it was taking in more money than it needed, all that money was simply thrown into the government coffers and spent. And so now we're running an annual deficit of the budget of around $1.5 trillion. This, don't forget, now this includes all the money from the Social Security Fund as well. So where did all that FICA money go? Well, as Terry Savage of the Chicago Sun-Times says, and I couldn't put this any better, it went down the drain of federal spending on everything. It's certainly not sitting in an account someplace waiting to pay for your retirement benefits. And so the big question is, well, who cares? Well, everyone should, because even though a lot of people, about 41% of Americans today do not pay any income tax, the majority of people pay payroll tax. And there are some credits that people get back for the low-income families that could take this down. But for the most part, anyone that works is paying FICA tax. And so everyone should care. That very young people that are paying into this system, there's no assurance that they're going to get anywhere near what they put in back. Even baby boomers that are retiring are possibly getting a fraction of their money back. And so as this is the week after Labor Day, I just thought it would be useful to take a look at what people labor all day for and the payroll tax. And so everyone should care about this. It's a big problem that is facing America. And like I say, a lot of that comes from Terry Savage's article on the Chicago Sun-Times. So if you want more information on that, go read her article. It's very, very good. I'd like to segue into a little bit of a valuation update on the stock market. Since its peak somewhere around April of this year, the market has kind of been going back and forth. It went down. It's kind of stabilized a little bit. But one thing's for sure, it's up a lot since last year. And we hear a lot about the talk of the economy. And why should we invest in the stock market? Why has the market even gone up? Unemployment is still high. A lot of it has to do with valuations. And when we look at the valuations for the 4 quarters ending 2009, the S&P earnings were up about 243%. By mid-April, these earnings were up about 797% for the year ending June 2009. So although the earnings are up from a very depressed level, they're still up almost 800%. And when earnings go up 800%, you're definitely going to see some rise in the market. And so then the question becomes, well, is the market back to fair value? Is it still undervalued? Is it overvalued? And it's my contention that in March of 09, at the bottom of the market, the PE ratio had gotten somewhere down around 12. And we look at long-term data. I'm looking at since 1968, the average PE on the market has been about 16.7. And so there are data series we look at that go back even longer time periods. The problem when you look at too long a time period is you're getting into periods of time that were fundamentally different. For example, when the gold standard was still around, inflation was a different phenomenon. And, there were just, the globalization was not there. And so there is some value to looking at very long time periods. But for this particular study here, we're looking at the past 40 or so years. The median PE is 16.7. So we look at a PE in March of 09 of around 12, we would say, well, that the market was somewhat undervalued. Then we rapidly rose to, in the beginning of 2010, the PE had jumped up to around 22. And so the market was ripe for a correction, and it's since corrected back down to around 16.1, which is right around its 42-year median. So based on today's earnings in the past 42 years, we would say that the market is just about at fair value. And it's very important to acknowledge where you are in the investing world. And we'll talk a little bit about more of that right after the break. But we're going to take a message from our sponsors here for All Things Money. I'm David Blain. We'll be right back.